the right now you see a lot of speculation in the last couple months since June 15th, when there was supposedly this market bottom. And let me see. All right, so we had this time here. We had a downtrending market. Right about here, we started doing this ascending pattern, and then we have this channel going up. We mentioned last week that we were at the top of that channel, and it's a very good chance we'd be going back down to the end, the bottom part of the channel, and we were super overbought for how many weeks there?
4 weeks. 4 weeks.
That's a lot. So this is the first week we're going to be going down. Let's look at the S&P 500. Last I checked, we had a down day. Let's look. Okay, it's down 1%. All right, so as we were expecting, we're in this upward channel, and chances are we're going to at least go back down to this, if we're going to stay in this pattern, down to the bottom. So it looks like we're starting to go back down today, and we're super overbought. So what I was doing some work with the with Twitter to see how some of the smart people are interpreting all of this that happened in the past month here. And one guy here, let me show you who it is here. Okay, this guy here. He basically, he said this is the mother of all short coverings. It stopped, and it lasted 15 consecutive days in the prior 3 weeks. So he did a chart, and he mapped out the short flows and compared against the stock market. And there's a very good chance that everything that happened in the past couple of weeks were initiated by short covering. So that's something to keep in mind, because now those same people that were short covering are starting to press their bets on the downward side. So let's just keep that in mind, because right now we're going into two of the worst months of the year. Right now, August and September are the worst months. So we were expecting it to be negative, in general for this month in September, and we have on top of that we're overbought right now in the stock market. So we just this is the time you basically just watch it. You don't want to get carried away buying things right now, because it is overbought. Let's look at the calendar we have set out here. We have one thing to look forward to next week. We have Tesla splitting on the 24th. Other than that, we have an overbought condition, and basically it's pretty dangerous to start long positions right when we're starting to turn over on the stochastics. So our stochastics, you can see as of today, let's look at we're starting to turn down. We were like in this high for a while. We're starting to turn down. We're at 78, 70, 80 right now. And let's see. All right, so we have things to look forward to. We have Labor Day. We know around the holidays, people get really, they have a happier mood. And you also have and people are taking vacations, so you have less volume. There's a very good chance this going into Labor Day is going to be a good time. And we also have, there's a consensus that this is going to be a last rate hike. So that won't be on the front page of every newspaper anymore. They'll probably signal we're not going to raise anymore, and on top of that we have end of quarter window dressing. So there's a very good chance that we're going to, in this chart here, we're probably going to at least dip down to here. We'll get our stochastics down to here, and by the time Labor Day comes around, we'll be able to rally and start going up again. All right, so that's the big picture. I'll also put a little red in the October because people always get squeamish in the October time frame because a lot of the biggest crashes in our history in the stock market have been in October. So let's look at, but actually October has been traditionally a really good month, but for some reason people do get nervous. S&P is actually down 1% since the last meeting. I mentioned already that there's a short covering rally that lasted 3 weeks, and it's basically there's no more forced buying from shorts remaining, and we have analysts we get to watch right now that are cutting estimates. The idea of a meme stock is like all over the news, and it's very, very irresponsible for these CNBC to cover stocks like this that are going up, because that just eggs people on to buy more, and it's very these companies like Bed Bath and Beyond, they're fundamentally inferior stocks. They're definitely not trading, their true value, and their movements are just in general, as investors, you got to ignore them and not even get involved with that, because it just you can't get sucked into buying stocks that have no value, basically. So, and right now you can see a lot of the fraud is coming out of the market. You see Bitcoin going down big, Ether. A lot of these speculative things are like deflating. So along with that, you're going to have probably the stock market go down with it, because right now we're overbought. All right, so we do have a good indication that the core rate of inflation is going down. We have commodities like gas prices we see every day going down, and the employment situation is good. So there's a very good chance we're not going to. Well, I don't know. It doesn't seem like we're going to have that bad of a recession if we have one at all. And even if we do have one, it doesn't last very long. So it's nothing to get really worked up about. So I'm going to go over the catalyst of market going up and to go down. The things that happened this week. A really good article from Yahoo Finance. There's a major chain company that tracks chain supply, and they said the supply chain bottlenecks are getting better. We've been waiting for that for a while, and that's one of our check marks for the stock market to go up. You see, the other thing is we had 10 years going up. That's bad for the stock market. As you can see from this week, it's going up. So we still have that correlation. When the 10-year goes up, the stock market goes down, and vice versa. So let's keep our eyes on this 10-year yield. And you see, the other thing is that monkeypox cases are going up in America, and some cases are transmitted via being with groups of people. So we're going to keep our eyes on this, because if we have our playbook already for a pandemic, we don't think it's going to happen for this, but if it does, we're going to go over, the stocks that go up and down whenever there's a lockdown or whatever, and we're ready for it this time. We still have China tensions with Taiwan, and there's all kind of geopolitical events that are in that area this week. If there's something that happens with China and the United States, and we get to be in a fight or some kind of problems, that's a major issue for a lot of the stocks we're watching, because China, we might not be able to sell or manufacture things in China. Okay. All right, so let's go over the crude oil is down 5% this week. 10-year Treasury is up 2.5%. So these are, when oil is down, that's an indication that the economy is slowing, and that could be good for the Fed not raising as much. And we see 10-year Treasury is going up, and we all know that makes the cost of borrowing more for these companies that need to borrow money. And let me see. Okay, let's look at the sector ETFs, because today we're going to look at two things. We're going to look at this is this pre-markets page has a list. You can go there every day to see what's going on in the pre-market activity, all the top stocks. Let me see. But if I go here for the oil, it oils up a little bit. That tells you that the oil stocks are going to benefit from that. And that's all we can tell from that. Okay, now let's look at our things that are going in the stock market, the ups and downs, and we'll look at the sectors. Okay, we knew that the energy would be in the top, performers because the price of oil is up today, and everything else is pretty much is down. Retail stocks are going down the most today. What was happening this week with retail? Bed Bath & Beyond is down 40%. That's like 1% or 2%. That's a good percentage of this retail. Maybe that's why.
Target missed their numbers too.
Target missed their numbers. Target has a problem where they had a lot of inventory they couldn't get rid of, so they marked it down and they didn't make a profit from basically giving away. They had to mark it down a lot, so they didn't have it. Their margins didn't meet the expectations of the analysts. So most likely companies like Walmart might have that problem. Maybe Amazon down the road, but at least Target, I think they call that a kitchen sink quarter, where you basically get rid of all. That was their major problem. So if they sold off their inventory at cost or whatever, they wouldn't make a profit, but they wouldn't have that inventory problem. So, but those are things that freaked out the market today for the retail. Metals, home builders are down a lot today. There must have been some kind of home builder report that came out. I don't know. Consumer discretionary, financial. Okay, so we know. Okay, that's all I can get from that. Let's look at the market movers. We should have looked at market movers first. Okay, we knew that the oil stocks would be going up because of the price of oil. That was pretty simple. We have a lot of conservative stocks that paid dividends. People are seeing that, we're pretty extended and there's a chance, we're overbought. People are gravitating towards more safe investments that have a low PE ratio and pay dividends. So that's what we see here. We have Devon Energy. These are all oil stocks, but the ones that aren't oil stocks, Eli Lilly, they pay a dividend. They're a health stock with a low PE ratio. Bristol Myers, same thing. Johnson & Johnson, health stock. And General Motors, they just reinstated their dividends. They're now a dividend, raiser. So the ones that are going down a lot are all the speculative ones. Okay, remember we were talking when I signed in about Bed Bath & Beyond going down 40%. That just began, bubble pricked, and then all the speculative things are selling off because, I guess that's what it takes. It takes one to start everything. So we have Carnival Corp. They're still heavily indebted from not being able to be active in the pandemic times. So we have a lot of companies that have a lot of debt right now. As the 10-year goes up, the cost of these companies to refinance their debt are going to go up. And that's something that these top decliners have in common. You see. And maybe, just maybe, we might have a replaying of the pandemic playbook, because these kind of match. Look at all of them. These are all the ones that went down the most during the pandemic. Are we going into another monkeypox pandemic? I don't know, but we'll keep our eyes on this. But it's very dangerous right now having any of these stocks. Most of these stocks are the stocks that were shut down during the pandemic and acquired a lot of debt. Generac is a little different. Generac has, they install generators for your backyard so that you can have electricity for your house when the lights go out, and they have solar panels they put in houses. So that's a little different than everything else. I'm not sure about Match Group, but these are all stocks that went down during the pandemic. So let's watch those. The other thing they have in common is they're all super, super pricey. They have high PE ratios. So let's look at the NASDAQ, top and bottom. Again, we have that same pattern. We have oil stocks and we have drug stocks with low PE ratios and that pay dividends. Like Heinz pays a dividend, Gilead pays like a really big dividend, 8%, 7%, and Pepsi, of course, we're following. All right, so the ones that are doing bad are ones that, look at that. Ones that have very high PE ratios, like DocuSign, Lucid Group. A lot of these are heavily shorted too. So I guess we're seeing a bubble pop where all the ones that we've highlighted before as super expensive are people are gravitating towards more conservative ones today. So let's look at the Dow. Okay, we have United Health. They're reasonably priced and they pay a dividend. And you see one more time. All right. All right. So I think that's the same pattern. Dividend paying, conservative. The ones that are going down the most are a little bit more higher price to earnings ratios and higher PEG ratios. All right, that was great exercise. Glad we did that. Any questions on any of that? All right, last week, just to review, we noticed that this is hitting the top of the channel. We predicted that, and with the overbought situation, that we'd probably be going down, and where we're actually following that trend. We expect by this time next week we'll be at the bottom of this range. And this doesn't mean that we have to follow this forever, because trees don't go to the sky, and if we watch this bottom of this channel. If we break through that, then we don't have that support of this channel anymore. So we have to start all over again and draw another channel. I don't know where it's going to be, but this helps us maintain our sanity, just kind of following along with what's going on in the stock market. But so we are going down, and we have next week. There's no real news coming out, so we don't expect anything to be going up next week. All right. So in the fear greed indicator, let's look at what it is today. We have a lot of. I think we might be moving from. Okay, we're going back down. Okay, so when I put this together earlier today, like at the beginning of today, we were at 54, which is people were greedy actually earlier this week. So we had greed, and that's the opposite time when you should be buying. And so whenever you have a neutral, and now it's starting to go down, my guess is in 2 weeks will be fear, in 3 weeks will be getting the extreme fear, and 4 weeks will be down to really fearful. So we got to holding up the greed. If you look at our emotional gauge, let's go back to our emotional gauge. It's always good to go through this. There it is, right there. We had this position where oh, everything's almost back to normal. It's returning to normal. We're greedy again. And only it's that time when we start this whole downward despair thing, we're going to get back down into this capitulation. So, the reason why we're doing this is just whenever you feel like it's going to go down forever, it's going to go down forever. Those are the times you should be greedy, and you should, start accumulating when the stochastics are the worst, like right here. And whenever it's at the bottom of the channel, we have this channel going. Those are the times you should be buying, like right there. And the times you should be selling are the times like right now we're still at the top and we're still overbought. All right, and this is my theory. It might not work. I'm just saying this worked for me, so maybe it'll work. Who knows? All right, so we already talked about that. All right, so let's go back to the VIX. It's probably up today with the we're at a pretty much a low. If you look at the past year of activity, as of this morning, the VIX was at 20. 20 has been like the bottom. There's been a playbook. The VIX hit 20, hits 20, then you sell. The VIX hits 30, then you buy. So this is a counter. Just a way to, also another way to time, the stock market and or, understand when it's time to buy and when it's time to sell. All right, so we're at, I bet you VIX isn't at 20 anymore. It's probably at 20, 23 with today's volatility. Oh, that's okay. We know it's on its way back up, so maybe in a week or two it'll be back up to 30. All right, so let's see. All right, so we already mentioned all of this. Okay, so here's an article from Yahoo Finance. The guy, this company that tracks this, the New York Fed's Global Supply Chain Pressure Index, shows stress on the global supply chains eased for the third straight month in July. So we were looking for positive signs, in our checklist, reasons the stock market could go up. And this could be, something that's constantly improving. And there's a lot of constantly improving numbers that we're watching for reasons that a stock market to go up. For instance, the CPI is not going up as much as before. So we have improving lumber, we have improving gas prices. So everything's moving in the right direction, but still we're overbought. And that was all due to short covering. So we have a note from Jamie Dimon. He said to his wealthy clients, there's a chance the U.S. is heading into something worse than a recession. He said we're going to a hurricane earlier this year, 4 months ago. And he's like a fearmonger sometimes. Right at the bottom of the stock market in the COVID lockdown, he had these really cautionary words, about the stock market. So I don't know. I wouldn't put too much into this report or in what he says there. But he says there's a 20% to 30% chance of a harder recession, and equal odds there's something worse. So those are pretty good odds. That we're going to have something like a depression. I don't know. I don't see it, but he's a fearmonger, so let's keep that in mind whenever people start in 4 months from now when we're down. We'll look back on this and say, maybe he was right. I wonder why he was right. Okay, so the next little thing is ultra rich, fueling sales of luxury brands despite inflation and recessionary fears. Mark brought us the attention of LVMH. Mark, what luxury brands do you own? Can't hear you. That's okay. I know Mark was interested in LVMH because
Louis Vuitton, Moet Hennessy, yeah.
Okay, yeah, great. So it has a PE of 26. A lot of times, you look at an article like that. Okay, well, let's look at all the the companies they mentioned in the article, number one, these are reporting strong sales. And other companies, including Gap, have slashed their forecast and target. So I wonder why these companies, I guess they have, if you're a company that can afford this kind of product, you're not going to be affected by the recession or inflation or anything. So what I did was I looked at some of the more promising stocks that are competitors for this ultra-rich luxury brand group of stocks. And these are the competitors of, in this luxury space. And each one has a different stickiness, or their companies like LVMH is probably the top. They have Tiffany brand, they have Louis Vuitton. These are the highest priced and highest valued brands. Some of these other stocks like Capri and Tapestry, they have second tier brands like Tapestry. They have Kate Spade, a couple other ones, and they have Coach. Capri has, well, I'll go over this a little bit later, but they have not as good brands. That's probably why they're trading at a lower multiple, because they don't, they're appealing to a customer that is affected by inflation. So let's look at what I did was I chose these two because they seemed the low PE ratio, and one is Capri is 8, Tapestry is 11. So let's look at Capri Holdings. Versace, Jimmy Choo, and Michael Kors are their main brands. One big problem with Capri Holdings, Michael Kors, it's becoming like out of vogue, and they needed a little more clout. They needed, a name that was better than Michael Kors, and so they actually bought Versace, and they took on a lot of debt. And right now, companies that have taken on a lot of debt are getting hurt in their valuations because they have to refinance that debt. And so the main problem for Capri is, they're trying to get, they're trying to establish a great brand and get some respect for their company, it seems. So I looked through their annual earnings estimates just to see how they're growing. They're growing 9%. If you average out 10%, 8%, 10%. So they're growing around 9%. And their PE is 8. So they're about 12% undervalued. But the problem, one more of their biggest problems is that half of the market cap is debt. So they'll have a hard time servicing that debt as rates rise, so they won't earn as much. And they're still trying to build their brand. And if they are able to develop these brands into, this luxury set of companies and have similar sales and similar PE ratios, that's called multiple expansion. Capri could triple, at least double or triple from where they are at right now, if they can achieve that same multiple, which is 20, 30. And the same with Tapestry. They have 11 PE. They might be able to double, or if they can trade into this range of the other stocks around it. So let's look at Capri's financials. The forward PE is 8. Their PEG ratio is 1.14. So they're, just like I was saying, they're a little overvalued. They're 12. 1.14 is like 20% overvalued. The profit margins are good. The return on equity is really good. The one problem I saw, I only bring up debt when it's really a problem. Their total debt is $3 billion. And their market cap is $7 billion. So that's half the market cap. So that's considered a lot. So I guess if you're following this stock, you would would want them to start eliminating some of this debt so that they could have all their cash they're generating at least give back. You can give back to your shareholders instead of servicing the debt. So that's Capri Holdings. Here's something that Morningstar said about Capri. They said the fair value estimate is 63. So they said it's undervalued by like 17%. They said Coors lacks the brand strength to provide an economic moat. Companies like Ferrari have an economic moat because they only make a limited number of cars every year, and they have a car that's high in demand. But Coors is a second-rate label, and so now it is affecting the people that can afford this kind of purse. They're affected by the environment. So they also spent $3.4 billion to purchase Jimmy Choo and Versace. So it's trying to boost its status as a luxury player. So it'll take a while for them to work off that debt. So this is like it's a work in progress. So it's probably the worst name in our that just the ones we're following that we're trying to figure out right now. That's probably why it's PE of 8. It has the worst brand names. So let's look at Tapestry next, just for kicks. I forgot. CFRA, what they said about Capri. They said with significant margin expansion and revenue growth across its 3 big brands, the company benefited from a stronger consumer and pent-up demand. So, but they also said they were looking at it's slightly below its 5-year average forward PE of 10.7. So I looked at that. You look at its PE ratio. A lot of times, if a stock is trading below what it's traded for in the past 10 years, it's trading. So they said 10 is the average. So if you look at their low, this is the low PE, this is the high PE. So right now, they're trading at 8, which is below their historical 10. So they're 20% off of their normal where they trade at. So it's not very compelling right now, and we're just doing this for an exercise. And return on equity has always been around 30s, and it's been up to 50 in the past. But right now, there's nothing really exciting about this, if you ask me. But if this stock drops down like it did during the pandemic, like what was down here, it's around 10. Then we'll know the history of this and know, wow, we have a super good deal now. This was close to something we'd look at now, but the reason why we're doing these exercises is whenever these stocks do correct down to like $5 a share, then we'd see, the value in comparing these against their competitors and seeing that they're building their brands, etc. Okay, so they're at the top end of their trading range right now. So most likely they're going to go down with the stock market. All right, so we're done with Capri. We're going to look at Tapestry. This has a little better name, I guess, portfolio. Coach, Kate Spade, Stuart Weitzman are its top names. And I did the numbers. They're actually growing a little bit better. They're growing like 12 or 13%. And let me see. All these handbag manufacturers are affected by the stronger U.S. dollar. So if they report bad quarters this quarter, they're going to make up for that whenever the dollar goes up in value. Goes down in value. So they're also trying to strengthen their brands. And so all these companies are also having problems in China because of the lockdown. And they're not selling as much, and that's a good portion of their growth for their company. You see. Okay, so let's look at their history, see if they're actually growing. Their revenue is actually pretty much the same over the past 10 years, around $5 billion a year. So that's not growing at all. The earnings, pretty inconsistent. What we like to see is stocks like Google, they have like 10% growth of their earnings and their revenue, and in improving return on equity. Right now we have, everyone had a mulligan in the year 2020. You can see negative there, and it doesn't matter because everything was shut down that year. But you can see that they're improving their margins. They used to have a 17 return on equity, and now it's going 20 to 22 to 30. So that's one good thing for this company. Let me see. The forward PE is 9. So we looked here, and their forward PE is 12. So they're like undervalued by 20%. So that's why the PEG ratio is lower than 1. It's 90. So Yahoo thinks it's undervalued by 10%. So profit margins are 13, and return on equity is 31. Those are both great. And their total debt is $3 billion, and their market cap is $9 billion. So that's 1/3 of their market cap is debt. So they have a similar problem, but not as worse. It's a little bit better than Capri. So I think in general, Tapestry seems like to be better of the two. They have a stronger brand, and they have less debt, and they have little better numbers. Okay, so we look at, okay, here's another one that was mentioned in our article. It's Race. Race is Ferrari. So the interesting thing about Ferrari is they limit the number of cars that they make every year, and they charge a whole lot for them too. So, and they're always sold out. So the interesting part about all this is that they have a wider moat because of this strong demand from the wealthy customer. So I did the numbers here. They're growing at 18%, 10%, and 15%. So let's say that's an average of 15%. Their PE ratio is 42. So I guess because of their brand and because of their customer loyalty, and they're always sold out of their cars, there's a strong aftermarket for their cars. So because of all that, it demands a higher PE ratio. So they're trading at 3 times the growth rate. So in a bad market, in a really bad market, they'll trade down to a PEG ratio of 1, which is 1/3 of where they're trading at now. So they are growing, but they're only growing at 15%, and it's a really pricey stock right now. So if you look at their numbers, Yahoo Finance agrees with us for the most part. They think it's 4 times overvalued. Their forward PE is 42, so these numbers are very similar to the handbag makers, in that their profit margin is right around in the teens, and their return on equity is around 30 or 40. So you see, here's what Morningstar said about Ferrari. They said the fair value is they're overvalued by 25%. The price to fair value is 1.25. So they have a wide moat because how many sports cars makers are there, and that have this level of prestige, and they can charge that much for a car and sell it and have a backlog of people to buy it. So they made money from cars and from spare parts and sponsorships. So let me see. Race exhibits characteristics more akin to a luxury brand than an automaker. It exhibits excellent pricing power and margins, and as well as strong cash flow and returns on capital derived from its strong brand and reputation. So this goes back to what stocks work in this environment. And So Mark told us about, how he was interested in this luxury, space, primarily because the wealthy can afford things and aren't affected by, the macro environment, things that are happening with the economy, etc. So, okay, so this is race. We're going to look at Ferrari's numbers and look at, like we did at the other company, we're going to look at the PE ratio that it's had for the past couple of years. So they've had probably a PE ratio of 25 to 30 right here. Now they've jumped up to 60, 50 PE. So they're trading outside, like double what they're normally trading for the PE ratio. So we consider that kind of overextended right now. And especially when you compare it against other luxury brands. The other luxury brands we were following here, where are they? Okay, where are they? Other luxury brands? Competitors. We don't have race in here, but luxury goods, 50 for Hermes. Everyone else is around 26. That's half of what this one is selling for. So, it's really trading at a premium, probably for a good reason. They have a constant. They're sold out of their car. I don't know how many months in advance. But that was a good exercise. That was fun. Any questions on that? Right. I remember whenever Buffett added Verizon to his portfolio, we were saying, what the heck is he doing with Verizon? That does not match the way of investing. I mean, why would he invest in something that isn't growing, that just gives a yield, maybe a consistent yield, but it's unlike a Buffett to invest in something like that. And I think the reason was maybe one of his two people that buy stocks with him ended up, buying some of that. But what happens this time of the year, as of this week, a lot of the hedge funds, mutual funds, and big name investors have to report what they bought and sold in the last quarter. And I tried to look at some of our mutual funds we were following. It didn't update yet, so we're going to wait until next week. We're going to see what changed in the portfolios of the biggest mutual funds. Most likely, it's not going to change. But this article basically was grilling Warren Buffett on what he bought and sold. And he's basically buying more Apple. Apple went down to 137 or so. And he's basically topping that off. He already has a 5% stake in the company total. He's the biggest shareholder. The company is. And so he bought more of that, and he bought more Chevron. And let me see. So there's other stuff. There's other reports now. Other things that people are selling and buying. But we'll go over that next week because it has to be entered into the system, and right now not everything's there. Made a bet on Activision Blizzard. I think this is the one that's being taken over by Microsoft. It's like right now it's trading below its takeover price. So he said it was like a very good chance that Microsoft would be able to take it over. And Ally Financial is another one. He bolstered his bet on Ally Financial. Okay, so he likes banks. Berkshire Hathaway has some of its biggest positions in banks. He likes those because they have a consistent set of business that doesn't change a whole lot, and he can understand it. Okay, just for an exercise, I have a little bit more time left here, but I'm going to go over Verizon because we're following it. We've been saying for a while now that Verizon and AT&T are losing share to T-Mobile, and we're looking at it as just an exercise of when will Verizon cut its dividend. Their they're scheduled to grow at 2% average, 1.52 and 3.5% for the next couple of years. And so they have a stable dividend right now, but they're not really growing that much. They're losing market share, and they have a lot of debt. So one reason why Warren Buffett might have, got rid of some of this, or his position in this, is they do have a lot of debt, and as interest rates go up, it's going to cost more to service that debt. And another problem with these companies is they have to spend more money on spectrum over time, and maintenance of the lines. So there's a heavy capital investment, never-ending capital investment for these companies. So you don't have that kind of capital or expenditures for Google or some of the other tech stocks we're following. So all in all, this is getting to be a stock with a lot of warts. Every stock has warts, but some have more warts than other ones. But that's just another red flag for this stock. We've been following it with AT&T. Whenever one of the greatest investors of all time sells this out of his portfolio, we have to really look at it again. So it's growing at 2%. It has like a 6% yield, so 8% total return right now. It's not bad. I guess it's conservative enough for this environment. All right. So, so a PE, that Yahoo Finance kind of agrees with what we were saying. If it's a PE of like 10, current trailing PE is 10, and you divide that by its growth rate is 2, you get something like 5.5 times overvalued. So our numbers work out pretty good, but their total debt, look at that. It's just about as much as its market cap. That's going to be a major problem, refinancing all that debt every year. So we'll keep our eyes on that. But it's one of those ones that are more like in a bullpen right now versus, something that's like core and something we have confidence in. Last thing I'm going to say is there's a article that came out, 7 discount stocks to buy, trading down at least 20%. These are stocks that are currently down 20%, and I highlighted a couple we've been following. We know we're overbought right now, so Meta and Google are two that are basically still down 20% for the year. Apple is actually positive for the year. It rallied. It was the first one that rallied out of this downturn. I looked at some of these. We don't have time to go over this today, but I just highlighted that some of the stocks we're watching are still down 20%. You see, oil prices plunge after China's central bank cuts interest rates. Why would oil prices go down with this situation? Mark, do you know that? You're on mute. Anyone know? Okay. The reason why is China is one of the world's largest consumer of oil. If there is any signs that the China economy is stumbling or not doing so well, then the largest consumer of oil in the world will not consume as much oil, so the price of oil goes down if there's less demand. So whenever the China central bank cuts rates, that means their economy is struggling, and they have to cut interest rates to spur economic activity. So that's why oil prices go down. So, and whenever you're looking at news, oil is actually turning out to be a really big part of every company's earnings. So that's why we're like super sensitive to the price of oil and things around the world that could cause the price of oil to go up or down. Okay, that was a good exercise.
Interesting.
Yeah, but I'm just saying that if they cut the rate, isn't that shouldn't that make oil cheaper and then?
Yes. That's exactly why the price of oil goes down.
then people will start using it more.
Yes. Well, it's never-ending cycle. They use it
Yes,
more.
yes.
Then that means the economy is doing really good. Then we're in overboard, and then the price of oil goes up. Yeah. So that's like a never-ending cycle. We just have to keep our eyes on that because we know from all these reports we're going over every week how much the price of oil affects every company we're watching. So I didn't know about the price of oil when I was growing up. When I was a kid, I'm like, you don't think about these things. But once you start investing, your oil is like one of the biggest factors. And well, a lot of times the commodities and bonds and there's other parts of the market that tell us, the economy, how the economy's doing and how bad it's doing, how good it's doing. And oil is like just looking at that price of oil every day is a real good indicator of how things are going in the world economy and the United States economy. All right, that was a good exercise. The last little article I had is Home Depot had a sale showing America's housing market is still strong. That was just yesterday, but today we had the home builders down. So we have some conflicting reports. Home Depot saying, the customer, the consumer is doing really good and the housing market is strong. And then we have existing home sales down. And so we're just following that. We know from now until they start raising interest rates, until they start reducing interest rates, we're at a period of, housing is out of favor. So we know that. They were expecting Home Depot to be much worse, but they ended up being, stronger because I guess people aren't buying new houses; they're fixing up their own. I don't know. So this is one more. Oh, I gotta say this. This is real important. This guy is like a genius, Doug Cass. Whenever we brought this guy up whenever things were going so rosy last year, and he mentioned how Kathy Wood from the ARC, she was just this genius, and that's not going to last. It's going to go down. And now he's making this case, and it actually did go down. So he was right on that. When people think that everything's changed and there's something different, you have to be very careful, because that ARC is down 80% since then. But this guy says the bear market case, why we may now be approaching another important top in the stock market. Now, he basically said the markets have rallied since the June market low. To a large degree, the rally has been position-driven as the large hedge funds have de-risked and degrossed. So in other words, remember I was saying those short positions are basically covered now. We're at the top of this momentum thing. We know we're overbought. As the momentum in stock prices begin to improve, market structure and the role of passive investing products reversed from sellers to buyers. So he likes to think of the opposite side of things, and I think he's right most of the time. The fundamental backdrop is arguably deteriorating. So the earnings are getting worse. Valuations are not as compelling, and we have the Federal Reserve. They're probably going to raise more. There's sticky inflation. He's just saying right now, we've come a long way, and some of the market dynamics are saying we're kind of at a top. And he's avoiding the growing optimism right now. So he's like a bear right now. There are decades where nothing happens, and then there are weeks when decades happens. That's kind of predicting there's going to be some kind of market turmoil in the near future. So let's watch this and see if any of this happens. And we know that the last 2 months of the year are kind of bad months. The last 2 months, this month and the next month. So just be very careful and don't get over your skis. This one guy says the big rally from the bear market is more like a dead cat bounce. And I don't know if you ever heard of dead cat bounce, but this guy in 1986 said this applies to stocks or commodities that have gone into free fall descent and then rallied briefly. If you threw a dead cat off of a 50-story building, it might bounce when it hit the sidewalk, but don't confuse the bounce with renewed life. It's still a dead cat. So, that's like Bed and Bath and Beyond today. It went down lots. And tomorrow might go up 10%. But don't see that as like a revival in the stock. It's still a $5 stock. I already mentioned this and that. All right. So I think we come to the end of our talk. I went over like 1 minute. Sorry about that. Sorry for being late. Is there any questions anyone has?
So you said September is a good month, but September is supposed to be a worst month so far in the history.
That's interesting.
Yeah, but seems like it's gonna bounce in September. If these 2 weeks go down, then maybe September might be a bounce week. You know?
Well, we don't know. Let's see. The interesting thing is we have a holiday. We have not every September we have a last Fed hike, a rate hiking cycle, and the end of quarter window dressing. We have this artificial people buying. I don't know. I think we're gonna have we're overbought right now. So whatever it takes, however long it takes us to get to a point where we're oversold, from then to the end of the month, maybe, and then even then we might be down for the month. I don't know, but I guess what you got to do is you got to temper your emotions. You know we're over our skis right now in the stock market. Don't get too overextended. And this is a way to you have some kind of control over the situation. You can kind of follow it. And for me doing this is kind of like, I knew it would be down today, and you have that in your mindset. So you're not like scared out of positions, or something like that. So it's pretty easy if it goes down to sell, and when it goes up, buy more. But, I'm trying to trying to do the opposite and kind of like temper your emotions to buy more when it goes down and everything's oversold, and when it's up, don't buy, and kind of know there's crazy people out there. Don't follow them,
Yep.
Maybe like mid-September, maybe a good time to just kind of poke around and see if there are any deals.
Yeah, I think right now we're poking around right now. We know things are overvalued, but whenever we do have a crash, or we do have some kind of correction, like 5-10%, then the things we're following now, they're a little overvalued. Maybe they're down to $5 a share. We don't know.
Yeah.
So that's why we're doing these exercises. Even though we don't have the best deals right now. This is kind of Warren Buffett's dilemma. He has all this cash to use, but things are pretty highly priced. And
yeah.
I guess he bought Apple, when it was down 20-30% for the year, and that's all he basically bought. He didn't buy a whole lot of other things. So I guess that's kind of the way we can maintain our sanity through all this. And it's not like we're going to be day trading and buying and selling S&P futures or whatever, but it's I don't know. It's a way to dollar cost into quality investments and a way to keep track of it all.
Yeah. So Tesla is splitting next week. What do you think that's going to do? Like, you think that's
it's overvalued right now.
Is it? Yeah.
Yeah. It's overvalued. It's you see. Let's look at Tesla right now.
I believe, before it splits. So I think 900 is right. I think 1:3, right? Is going to split 3:1.
Let's look at Tesla just for kicks. There it is, right there. We did the charts on it. It's at the bottom. Oh, it's not that bad. So it's near the bottom of this channel, but it's still overbought. So let's look at the statistics just for kicks. The easiest way to look at statistics is look at Yahoo Finance, and then look at statistics part, and that tells you right away how overvalued they are. So it thinks it's 2 times PEG ratio, 2 times overvalued, 2.2 times overvalued. So its forward PE is 78. It's not growing at 78 times. I mean, it's not growing. Its earnings at 78. Just for kicks, let's do that because we don't do very many requests. So we're gonna look at E-Trade. We're gonna look at how much it's growing. That's a good thing. Get in there. So this example, if I have $50 in this account, but I can use unlimited research. It's kind of amazing.
Nice.
All right. It's earnings. Look.
They have beat this every last 2 years, and that's amazing.
Okay, so we're looking at right here these numbers. We're dividing 22 by 23, and that's around 28% growth between this year and next year. So that's 28%. Let's look at that. It's 28% growth. 28 times 2 is 30. So that's how it gets 2.8. You divide 78 PE by that, 30. And that's how you get the PEG ratio. So it's only growing 17.19 divided by 20.8. That is around 20%. 18%, right. 20.80 divided by 21.03. Okay, so then it grows to 2%. But yeah, we looked at this last week. So it might be turning in like a normal car maker right around this 20-25. That's what they're saying.
I think once they're done with this splitting, it won't go as crazy. It won't go as crazy. It will normalize because that's why they do splitting. Because once you do the splitting, then it will start normalizing. You want to bring it to a point where that's why S&P or the board of director, not S&P, sorry, the board of director might be doing splitting pretty quick. In last 2 years, they have done it twice because they want to stabilize the price. Once you do that splitting value, then it will stabilize. The price won't go this crazy. It is kind of stabilized from last so many years. Because it has been performing in market no matter what. None of the EV companies can touch, even go closer to Tesla. That's the big positive point about Tesla.
Okay, let's look at the big picture for Tesla. It's 2 times overvalued right now. So if you see the lower highs and lower lows, right? Here's the high. Let's do a map just for fun on the big. This is like a 2-year chart, right? So now the danger of buying a stock that's trading at twice its growth rate, right? Means that in a bad market, in a really bad market, where everything's selling off, there's a good chance that it'll trade down to right here, because then it'll be trading at a fair value. It'll be growing at 20%. The PE will be 20 down at this bottom of this range. Does that make sense?
Yeah.
And on top of that, there's support. There's support, multi-year support right here. So you see that where there was support before, like in May. So you have to be very careful. Right now there's, it has a lot of momentum, I guess, but I'm just saying I wouldn't buy it for my long-term portfolio because you have an unpredictable Elon Musk that might have to sell. He might have to sell it in order to buy Twitter. We don't know. And then if you have 10% of the stock going off the market, right? That's going to put a lot of downward pressure on the stock. So we don't know that. So that's intangible. But I'm just saying that. This is
I'm
one
curious
stock
to see
we're
what
following.
it does to the market in general, to this stock or the market in general. How does the market react?
It's not a bellwether stock like Apple or Google or one that's a big percentage of the S&P and the Nasdaq. Like Apple is like a certain percentage of the Dow, Nasdaq, and S&P. So it doesn't have as much of a
True.
effect on it. Maybe the Nasdaq QQQs, but not the other major.
So Tesla, I think Tesla is the most volatile growth stock. You can say that way, Kiana.
Okay.
And as it is a part of S&P, they won't let it go crash. In a snap, because it is a part of S&P. So a lot of funds, they are holding Tesla right now. Right? So if you look at from January to now, Tesla had not fluctuated much. If you compare the 1 year chart, it has not fluctuated as much as the whole market has. Most of the stocks dropped 50%. Consider any stock, Tesla, Google, maybe Amazon, even Apple went 40% down, 30% down from its all-time high from January till now. But Tesla has not. Tesla has followed S&P trend. It has not gone great. I think the lowest was like 720 or 780, 740, something like that. And after that, it bounced back up. So it hit that point. Now, now it's all... I think once it splits, it will be more stabilized. I think good that it is splitting. It will be more stabilized.
I'm sorry.
Go ahead, yeah.
Yeah, the one thing I wanted to bring up was that, if you're buying this to hold, if you buy and hold this for like a long-term investment, you have to constantly monitor the earnings, just in case, it turns into one of the other car companies. Then the price will deflate whenever they start having these 1% earnings growth years. Like between 24 and 25. If you monitor this, and every year that is expected to grow 2%. If it only grows 2% 1 year, they're going to get hit because the peg ratio will be down to 1 whenever it fails to meet these 20% growth rates of the past, right? So you have to be very careful.
That's what the analysts are saying right now. 2%. It will be after long term. It will go the earnings will reduce for sure. That's with any company, but it will take some time. Analysts will say one thing today and then they'll revert back immediately the next day. So that's how it is. One day analysts want Trump. The next day they want Biden. So that's how they are. So the better is to look at the numbers. That's more important.
Yeah.
And what innovation they are doing, So I'll tell you this, when I bought, there's a company called, the ticker is Net, is Cloudera? I think Cloudera, Net. When I bought that ticker, analysts said, it won't do good. But they have Cloudflare, sorry, not Cloudera, Cloudflare. So, but now they did good over the period of time. Like they dropped during the when all the stocks were dropping, they dropped and then they came back up. So this is the trend with all the stocks right now. Tesla right now is the most volatile stock. You make money out of it and you get out of it. That's the best way of. That's why I play with only options. But sometimes options can drag you down as well. Yeah. So you have to play smart. Like how Greg said, right? Right now, Greg knows that we all know that market it will come down this week or the next week to, it's a small burp that comes in every time when you eat too much. Then the burp has to be there. Else it will be like, it's a fact. Else it will be like throw up. You will be throwing up things. You don't want that from what happened from January to September. January to now till June. 2 quarters. Yeah, negative week is good for the market, for the bull to carry on. So and today, by the way, today market is also down because it may go back up after 1. That's what I was expecting. Because also about 2.3 trillion worth of options are expiring today. Today's option option expiry month.
So it's gonna be a very volatile day if it's options expiration.
Exactly.
So it might just end up today. We'll see.
Yeah,
Let's
yeah.
watch.
But end up or swing back, swing negative, stay negative. But that's why a lot of options. That's why some people are selling as much as they can. Yeah.
Right.
All right, guys. I have a one-on-one, so I'll talk to you guys later.
Yeah.
Sounds good.
All right.
Have a good weekend, everybody.
Hey, thank you, Greg. Thanks again.
All right,
Thanks.
thanks.
Bye.
Thanks.
Bye.
Bye.